Shawn, welcome to the show.
Thanks for having me.
We're going to talk about all things investing, startups. But first, I saw this in your bio, so I got to ask because I am god awful. It's probably been a decade, and I don't think I've ever won a single fantasy sports league ever. And you self-admit to being pretty good. What's the secret?
Just have to be a little smarter than the rest of the people in your league probably and have some luck. It's kind of like startup investing. I don't know, I've been doing it for a long time, same group of friends, and it's and then the motivation is bragging rights. And so, everyone has their
Either
different
that
motivation.
or you just got not particularly bright friends. This reminds me of
they all of them went to Berkeley in my
yeah.
main league, so they're not that dumb. But I don't know.
It reminds me in LA, they have a particular trivia night at an Irish pub where it's like all Jeopardy winners, and it is so impossible. Like I didn't even understand some of the questions, and so I just kept going to like the easier and easier trivia nights till at some point it was like basically like a middle school trivia, and finally won one. So my only because I'm a quant, my only sports typical one that I win is, the pick'em leagues.
Yeah.
Where you pick versus the spread, and it's a closed community. And so those, there is a small edge you can have, which is if you fade the consensus, because if you're in a league of say 50 people, often like 45 will line up on the same side. And so if you assume that either the lines are accurate and random, or there's usually, at least in the academic literature, says there's a slight edge to fading the consensus, that's actually a winning strategy. But the problem is that's not the fantasy league. So I'll hit you up on draft night.
There are some strategies in it, right? Like, and I have like some well held, and like a lot of it's based in math and averages, and where you can kind of make up deltas and then find value, from other kind of players and take some risks. So I don't think you're wrong. Like I think I employ that strategy probably in like, I don't run spreadsheets on it. I don't think it's necessary, but there is a strategy that's in my head that I've always used. So I think that element exists.
It's a good analogy though. Like you think about the competition. I mean, it's a lot easier today where it has like the auto drafting and it tells you like what the player maybe should be worth. Like back in the day when you had to mail them in, like that was where you could really come up with a ARB. All right.
It's always how much spread you can get from the mean, right? And that'll have the highest score over time, and that's what'll get you to hopefully win more consistently, put up more W's, get more points, and then win the league, right? So it's a little bit of all those things.
So you said you're a Cal guy. Where was your first stop at LiquidNet?
No, graduated from Berkeley, did 5 years in kind of advising people in and around startups on the tax side and then banking side, first 5 years. Then I jumped over to the operating side at a company called Reach Local. We were helping companies do online marketing. We were doing online marketing for SMBs, so search marketing, display advertising, and social media. Venture-backed startup, knew the founding team really well. I ran Corp Dev and BD, so did that for about 4 years. That company went public. So this was kind of in the time when Groupon and Yelp and all those kind of local startups were getting built, and we were selling these media, performance products to SMBs globally. 20,000 SMBs were our customers. When I left, we were a 400 million top line business. After that, we got backed by LiquidNet. Me and my co-founder, we built a private shares marketplace to connect mutual funds to late stage companies. So companies were staying private longer. Facebook was a $100 billion private company with not one mutual fund on the cap table, and so we wanted to solve that with software, and that's kind of when I started my first company before getting into venture in 2014. After that,
what is LiquidNet still around? And tell me what's the status of that, because I remember there used to be a handful of these kind of secondary exchanges. Is that what you classify LiquidNet as, or is that inaccurate?
Well, LiquidNet had a core business, which was a software to enable mutual funds to trade public shares between each other above the public markets. That was their core business. They were PE backed by Summit and TCV when they backed us. We built like at the marketplace as a on subsidiary on the West Coast. So, quote unquote independent, or that was the theory behind it. So we took it to 150 million in GMV. Today, after we left, the goal was to get it to scale, and that's how they aligned incentives. But you need to have, I think, when the founders leave, you're able to integrate and continue or not. So the business kind of eroded over time after, we were the guys that knew the valley, and that's what we were brought in to do. So I wouldn't say they're a major player. I mean, there are other marketplaces. The way we were thought about it is, secondary, like they're back then, those days was like Second Market, Shares Post, etc. Or really, investment banks doing private placements. Like that's essentially, that's a more offline way of doing it. We wanted to use software to make it more, make it easier, just like any kind of software product, things that we invest in at Parade. And so, we built it. The intention was, it could be a secondary to kind of catalyze that event, or it could be primary. It didn't matter. Mutual funds want access to the cap table. And so the cap table is 100 points, 100%, it's one pie. And so they wanted a piece of it. And so that was not the motivation or the issue, but it could be catalyzed by, an early founder selling, and that could catalyze an event, or they were raising primary capital to drive the business. Mutual funds are long-term capital, mutual funds that invested in Amazon and whenever they went public, I think 98 or something like that, they still own it to this day. They might not own the same amount, but they own some of it, and that they've always been long-term capital in the ecosystem. And so just they behave differently.
What is the status today? We're already off topic, but as usual with my pods, but what's the status today on sort of private private secondary marketplaces? It seems to me, and I could be wrong, that there hasn't emerged to be a big winner. It seems still fragmented. It seems like it's there isn't an offering that to me seems widespread. Is there reasons for that, or am I totally wrong?
I think one of the biggest ones I kind of took, and I know the founders, Forge, I forget what they were called before that, but there was a YC company, and so they're pretty big. We wanted to be like a B2B marketplace, right? Mutual funds being one enterprise, buying from the company on the other side. We didn't want to, like Shares Post and Second Market, we're tailing to the retail investor. Like we'll let the mutual funds deal with the retail investors, and so that was our go-to-market. I think Forge is more retail investor centric, but they might have a B2B play. I'm not that close anymore, but I'd say, instead of the marketplaces, you have large pools of capital in the private markets in the late stage that are buying it, buying it for themselves, right? So it kind of defeats the purpose of having that marketplace, or it's less important, etc. I hope does that make sense?
Yeah, it does. We've had equities in on the podcast before, and they tend to be, I think, more individual retail focused, but it seems like, and maybe I'm just spitballing, some of these SPV sort of companies that are emerging have the potential to kind of cross over. Anyway, it seems like it's still a little bit of almost like a fragmented world, but I'm also not plugged into it as much as some. So, all right, startups. When did you start sort of startup investing on your own, or did you join a shop? What was the intro?
No, well, I built a marketplace for investing, and so there was a small, what I perceived, so I knew the players pretty well, and there was a small company called AngelList, and we, knew the CEO Naval Ravikant, and my friend Gil Penchina was an investor in the company, and they had released a small product called syndicates, which were essentially turnkey SPVs, and back then they had like a leaderboard, and Gil was a super angel, and he was kind of one of the more active people. And so we sat down and we said, hey, we think we can build a new age venture firm on top of this platform. So I at 2014, when we started what was now called Flight, or it still exists, Flight VC, we had an idea. We had our operator hats on. We were both entrepreneurs and operators, and we wanted to build something and disrupt venture. So, we just wanted to do something different. And I had a point of view from what I'd built before. So that's how I got in a venture. I didn't join a shop. I wasn't like a super active angel investor. I'd started advising and investing in companies, but it was more of two friends having an idea and wanted to do something different. And so we went and built a brand on top of AngelList and became, the most active investor, I think, across that period, 2014 to 17. And I still use AngelList for my SPVs. Maybe not in the same fashion that we used to leverage the platform back then, but we use them for our back office for our SPVs now.
Yeah. And so, I mean, I've been essentially following you and Gil since that time. I mean, started investing when AngelList started rolling out the syndicates in 2014. And tell me a little bit about the methodology then, and we can, compare that to what you do now. But also correct me, was Flight, did it have sort of like a multi offering, or was it targeted to sectors? So I remember there being multiple sort of Flight syndicates. Is that right?
I mean, look, we're founders, so we were always trying to do something different and test different things. So I think on a couple of things, like initially, AngelList was a platform for retail, for investors, for consumers. It was a consumer platform, and so we wanted to build a brand that consumers would come to, and so we wanted to give access to venture capital, this high risk part of the part of asset allocation. You're an asset manager, asset guy, so you understand, and that's inaccessible for the layperson. And so we wanted to give them access to Silicon Valley or technology. And so that was our thesis. Back then, we had, Gil and I were pretty active within the community, and we had, why we thought we could bring great deal flows, because we had done it. We had invested, we had spent time with people that were raising money from the top tier names in the Valley, like, the best firms. And so we wanted to give that access, we wanted to bring it to the people. And so that was our initial kind of wedge. And then we had ideas that we would test, like operators test all the time. And so one of them was, hey, just like people like a variety of mutual funds, going back to that analogy, you can invest in international, you can invest in India, you can invest in micro cap, large cap, et cetera. They'll probably want to invest in different sectors of startup land. And so we started creating syndicates around different themes. And then we would also bring in people that we said were experts in those themes to potentially run them. So sometimes we'd run them ourselves and or bring in deal flow that was consistent with the theme on our own, but we would co-run these syndicates with those people. And really, we built out a venture partner program on steroids. And most of these people were people that were just like us, and they were still full-time operators. They were doing some investing on the side. And so we gave them an avenue with our LP base to make investments. And they were already writing checks with their own capital, but investing other people's money and partaking in carried interest if the company did well. And so that leverage was pretty powerful. And so, we experimented, and we had some success with that. We started, people that still use the platform, like Zach Colias, his first couple investments were with us. Cruise Automation was with us. And so, totally stoked to see where he's taken everything. Like, he's blown it out. But, you need capital to invest in companies, and we brought a lot of capital to the table.
Great. So what is the timeline origin story with Parade? When did that start?
Yeah, I mean, so over the 4 years of Gil and I investing together, I learned, we were building out, not only operating and building out our brand, but, figuring out who we were as venture investors. And so, I loved spending time with companies. And so I did all of our deal execution. And so I would touch every company. So over those 4 years, between Gil and myself and our venture partners, we invested in 140 companies, put $60 million to work, mostly seed stage. And so I would touch hundreds of founders. And so they would come to me, and then I'd build relationships with them, because I'm pretty good at that. And they would ask me for help, and I'd love to help founders. Meb, you're part of this, and the structure of these SPVs. There's no management fee with these SPVs, and so it's really hard to run a business when you have no working capital. Imagine a startup if they had to do that. It's like you have no money, and you have to go create value. You have to hire people, and so I was spending a lot of time with these companies, and I love that part of the business. There's really two parts to venture. There's a lot of people say, where are you getting your deals from? How are you sourcing them? How are you winning them? And that is a part, making investments. But the second part is value add. And for me, it was spending time with the companies. And that's just not scalable as one person. And so, we needed some infrastructure. We needed to build it. And so I got together with Gil, and I said, hey, we need to take this to them. We've kind of broken we've kind of too big for this platform. It's not built for what we you take risk when you build on top of someone else's platform. You've seen it with Zynga and Facebook. You've seen it with a ton of other examples. And so that was a risk we took, and it was very fruitful. A lot of those investments are doing very, very well. I think you're a part of some of those SPVs. And I realized that we needed to raise a traditional vehicle with management fees to be able to scale our effort. And so we got together and put our heads together. And when you raise a venture fund, the difference between the SPVs is it's a commitment. You're managing that pool of capital that you raised for that fund 10, 12 years until it's done. And so it is a really long-term commitment. And by the way, when I started Parade, I didn't even know if theoretically I was a good venture investor. I was getting into investments. They were showing progress of Series A, Bs, and C rounds. But what makes money is not just IRR on paper, it's returning money to your investors. And that turns out that takes a lot longer than 4 years. We were super lucky. I invested in Dollar Shave Club, and we did create DPI for some. We invested in Cruise and a couple of other companies. But the best outcomes when you're a seed investor is the longer you hold, they become billions and billions of dollars of value. That just takes time. And so, I thought our best strategy at that point in time was to raise outside capital. And Gil just didn't want to. That was a commitment for him. He'll say it today. And so, and he was also the co-founder of a company that was doing very well called Fastly, and they were about to file to go public. And so, it was kind of, we just sat down and he said, look, take over what we've built, or I'll be your first check in whatever you do. And so eternally grateful. We had a fun run. We worked together for 4 years, but that was kind of when I thought long and hard, there are pros and cons to both. And I decided to start Parade. And so Parade's just a culmination of everything I learned over the previous 4 years under the Flight VC banner.
Awesome. So this gets started about what, 2018?
Yeah, we launched Parade in 2018, started raising, closed the fund in 2019. Same stuff, focused on seed investing. And because we spent so much time with the companies, like high conviction, high partnership, we meet our founders every other week. And so we take large ownership in most of the companies we invest in, around 10%.
Awesome. So this is exciting. You're now on to fund 2, and congratulations on that.
Thanks.
Let's talk about the framework. What's your philosophy? What are you looking for? What types of startups? You mentioned you've done over 100 over the years. Have they been in particular industries or approaches? Talk to us. What you've been funding.
Yeah, so we like to build relationships with people. We like to get to know them. We spend a bunch of time. And so part of our diligence process is like really building deep partnership with the people that we work with. And that's what enables us to win. And then we take large ownership in these companies. And so we're writing checks from 300K to 1.5 million to get our 10% ownership, like a traditional seed fund. And then my work experience, as kind of mentioned, has all been B2B. And towards the end of, investing in Flight VC, I mentioned the Dollar Shave Club investment, but, it was kind of 50-50 consumer and enterprise. And towards the end, I was kind of focusing on enterprise companies. So things with B2B sales motion, high margin, subscription revenues, and even like a Dollar Shave Club or a Hooked, which is one of our companies, they're subscription products. And so they have a lot of enterprise feel to it and kind of the way you'd measure them and think about the business. And that's why Dollar Shave Club had such a high multiple on exit, is because it wasn't just a razor blade that you'd buy at a store, something you'd subscribe to, and they had high retention, et cetera. And so those are characteristics you look for in enterprise companies. And so we're an enterprise themed fund. We like to help a lot from that perspective. And so we've done within enterprise have been pretty flexible. We've done kind of DevOps and ML ops. We've done vertical SaaS companies. We're pretty flexible from that perspective. And we can move faster when we really understand like a space deeply. And then there's other areas, like I invested in a veterinary diagnostics company called Moicor. They just raised a Series A. I don't have a dog, so I had to learn about the veterinary space. But they are using AI and machine learning to take complete blood counts, to take a blood sample, turn it into data, leverage that data set to give faster feedback and results and better outcomes for veterinarians and the pet owners. That I can understand. I can understand turning things into data and building models, but had to learn about the sector a little bit before investing.
Well, I'm sure most of the listeners will have heard of Dollar Shave Club. There's another one. Would love to hear you talk about. I don't know if this was at Flight or more recently. It's 50-50. I haven't looked, but I may be wearing Stance underwear. I mean, this is probably TMI for the listeners. I love their socks. You, by the way, I can tell you have good taste because you're wearing, is that a Champion sweatshirt?
Champion sweatshirt. Yeah.
I went to high school in Winston-Salem, North Carolina. Hanes headquartered there. So like one of the like 2 or 3 companies in Winston-Salem. So that definitely close to home. But Stance, one of these breakout brands. Talk about your thesis there. I mean, it seems like in this day and age, socks are kind of on the other end of an exciting sort of rocket ship SaaS startup. What was the concept there?
Love the product. I love the product. I had access to the CEO. I'd met Jeff a couple times. I mean, this was actually a later stage investment, and I was like, got to know him. I love the way he thought about brand, and I thought it was crazy that he was charging $20 for a pair of socks. Like, how much these things cost, and so the margin profile was like a SaaS business, like, very high margins. And I thought the potential to introduce things like subscriptions, et cetera, and then other products around the brand made sense. And he was, they were one of the earliest people to leverage influencer marketing to drive grassroots adoption. So like, I was just fascinated with the team that they had built. And so like, I was just like, let me invest whenever you have a round open. And so they did. And we cut a check. And so, it's doing pretty well. It's done pretty well since. And yeah, I'm an avid user of the product. I think I'm also wearing their underwear.
This hits upon a topic that I think is an area that I focused on over the years, where the majority of the investments have been sort of seed or pre-seed, seed, and Series A investments. But there's a special category of like this old Peter Lynch methodology, which is like, know what you own, you potentially have an edge, and then in your world, essentially inside information from the company on metrics, inside being a good thing in private startup world, as opposed to my world where it's illegal. But this concept of products you love, and it could be a little later stage, but I certainly would have put Stance in that category, but ones that are kind of early stage breakout. I still think that's an area that individual investors, as well as institutions, of course, can have an edge in sort of being able to see those trends and see a brand before it really breaks out.
Yeah, no, I think that's right. And it's like following your instincts and following that is asymmetry of information. I mean, even as a seed investor, right? Sometimes we like, I'm the first investor usually, I'm usually, one of the highest owners and sometimes board members. And so by definition, you build a relationship with the founder, right? And so you have all kinds of asymmetry of information, and even an advantage to invest more capital in the business, regardless of any contractual right that you have to invest in the company. And I think, savvy investors, and historically that's been the case, they take advantage of those edges, to your point. And I think, yeah, so we try to do that very actively. Like, and, one of my LPs, he called me the other week and he was talking about just, the idea of compounding, right? Everything you get taught about compounding, a penny can turn into a lot of money if you save, and you save a penny every day and it compounds into interest. But what about compounding relationships? And so when you invest in companies, take advantage of that edge. Instead of looking for net new, if you have something that's working, why don't you compound on that relationship? So I think that philosophy is super important and should be, and I think about it actively. It doesn't have to just be monetarily driven.
Yeah. How do you think about, we'll come back to some companies in a second, but why you mentioned this, it's such an interesting area. How do you think about portfolio management, and the concept being, obviously it's easy to deal with the losers. They go to zero, right?
Not really. I still can't get used to it, man. I'm not good enough to accept them. Well, get emotionally attached. I'm the first investor. I love them. I love the people.
On a emotional, psychological side on one side, but I mean on a mathematical, pure,
totally,
return side, the most you can lose is 100%. So, right. But what I was going to ask you is, how do you think about the big winners? And, and I understand you may have a fund that may just distribute the the shares if they go public or whatever. But so just as a sort of happy hour coffee talk about how do you think about it personally, but as well as just think about it in general, where you have a company that breaks out, right? So you have that magical unicorn, amazing, but it looks like things are still going right. And so it has a potential to go billion, 10 billion plus. What's your approach to eventually selling? How do you think about it? How do you think about it in terms of your entire portfolio and context? Any hard and fast rules, any soft rules, all that good stuff?
Well, I think first and foremost, like, especially, I mean, the two exit scenarios of old or M&A and IPO. So, those things happen over time, usually as the first investor, and then not always the biggest investor going forward. You have less influence on that. It's really going to be a founder's and a board's decision. And, we take board seats sometimes, but we're probably not going to be on the board by that point. So it really is going to dovetail to your relationship with the founder. And so I think where you're going with it is like, how do you manage like secondary? We talked about it earlier, how do you manage secondary sales potentially? So if you have a great relationship with the founding team, I think you always have an avenue, an edge to sell shares or get their support, and we'll be able to navigate that. As mentioned before too, there's only a fixed amount of access to a cap table. So if a company is doing really well, there should be excess demand rather than the supply of shares on the cap table. So I think that's only beneficial for a seed fund. So I think, given the asymmetry at play, and it's important for us to manage the capital appropriately. There are other, I don't want to spend too much time on it on this call, but there's tax implications, as well, for not only for myself, but for more importantly, our LPs. And so we're thoughtful of that as well. And so holding the shares for a sufficient amount of time. We have a couple that we've held for 5 years that are big positions now from before, that we are looking into. Yeah. How can we reward? Because right now you have to look at that investment, and it's like, if I can pull money out and reallocate some of it, take some of those gains and reallocate somewhere else where I can get another 20, 30, 50x, as opposed to eking out another 2x that can make, what's a 75. And these are like real companies I'm thinking about right now. That could be a 150. Might as well just reallocate that back and try to get another 60 and then pocket some cash,
Yeah. And so like, it's an interesting thought experiment. And I talked to a lot of public market investors about the same thing. I said, 99% of my friends in the investing world, talk about the buy decision, and this applies more to stocks than kind of the private. But a lot of people don't think about the sell decision, and the off chance. And look, it's a good problem to have, that you have a company that goes full rocket ship. So obviously happening a lot more in the last couple of years, but even if you had, just for example, a stock portfolio of 10 stocks and one goes, 10x, well, all of a sudden you have one that's half your portfolio. And the challenge that I was kind of referring to is, but let's say you're just stone cold, still bullish on that company. You're like, my God, it's only just now seeing it's like J curve. This could easily be a 10x from here, 100x from here. Anyways, it's just, I was trying to like walk through like,
I think communication is important. I think, communicating that instinct and that, with clarity or with some, and assessing that risk and communicating that with your LP base. And I think hopefully over time, you've built up some level of trust. And so I've seen it go both ways. I've seen, where someone owns a bunch and they have a point of view and they've sold out and they've returned a ton. I'm thinking of another person and scenario, but they've returned a ton of money to their LPs. And so I've seen in that scenario, and could they have held and had an even better fund? Now, if you go ask those LPs, they're never going to be mad at you for making them money in a short period of time. So I think as long as you communicate effectively and have a point of view, they'll afford you to be wrong. And we're talking about wrong relative to what? Relative to a big gain you've already made. And so I think there is some wiggle room to be quote unquote right or wrong. And you don't have to be in those scenarios. You're going to be right some of the time, and you're probably going to be wrong some of the time. But, on a show like this or on a podcast, you're probably only going to be talking about the rights more than the wrongs at the end of the day. So I think also like framing, and understanding that from like a viewer or consumer of information's perspective is pretty important.
Yeah. I mean, we also tell people that, psychologically speaking, there's so much emotions wrapped up with money, trying to avoid the temptation to be necessarily all in or all out and have that hindsight regret where no matter what happens, it's like a coin flip. Either you sell it and it goes up or goes down. Half the time you're going to be probably disappointed. So there's potential to like scale in and scale out or
Right.
sell
That's
some.
what I was going to go. I was like, it's not even a binary. Like, are we selling or are we owning? Right. No, we can
Yeah.
sell a little bit, you know, and
Yeah.
and pay back our principal, right, over time. So I think, yeah, I think there's many flavors of gray to answer that, or to
Yeah.
play that scenario out.
Well, listeners, the takeaway for me is think about it ahead of time, because once the emotions creep in, it gets a lot harder, particularly when money is involved. Let's talk about a couple companies, maybe use them as case studies. There's a few I know I have been pinging you about over the years that I love. And I'll let you kind of pick and choose, but I thought we got to talk about Inkbox, one of my favorite startups ever. What was the original thesis there? Tell the listeners what it is, and of course, how this come across your plate, and what was the invest decision?
Yeah, we're talking about a lot of consumer businesses. It's kind of counter to my current thesis, but no, I mean, Inkbox, when I think about consumer startups, especially that have a CPG component, I always think of like, what is the moat for the business, and kind of, is it defensible over the long term? And so, immediately, my friends at Golden Ventures were spending time with Inkbox. They're based out of Toronto. They had been spending time with Tyler, the CEO, for a number of years. They'd mentioned the company to me, and immediately kind of was like, I get this. I have 0 tattoos, by the way. But I have thought about it over time, just never pulled the trigger. So I understood like the concept of try before you buy, or experimenting with it. And I just thought expression from, a millennial and Gen Z perspective was kind of was an area that was just growing. Like they were expressing themselves in different, it could be online, it could be with clothes. And I thought that this, and then tattoos are on a rise generally. And so that was just a big industry. And so I thought you would never be able to quantify this industry that they were thinking about, which is temporary tattoos. But what they had built was proprietary, they patent pending ink that if you put it on was temporary, but looked real. So like that whole concept, with all of these narratives that were bubbling up for the youth and even older people, I thought made it a very, the thesis I thought was very sound. And then going back to things like unit economics, the things we do think about from an enterprise perspective, a very high margin product, very strong CAC to LTV metrics. And so they were very strong from a metrics perspective when we analyzed that. And the CEO just had this vision. And so, yeah, it's been quite a ride. The company is doing a significant amount of revenue today. We invested in the seed round. We've participated in every round since, and it's been a heck of a ride. And we think this is still just the beginning.
Yeah, I mean, for the listeners, I mean, they have this entire suite of beautiful tattoos. They last a couple of weeks, and for everyone that's probably over the age of, even 30, remembers, or even 20. I mean, I guess the status of the quality before this was always these like terrible temporary tattoos. You'd rub them on with a sponge and they would last like an hour, they'd flake off. And these they look like real tattoos. The thing that we need to convince them to do, and I do it on Twitter every once in a while, and I pinged you about it. I was like, you got to get these guys to start a subscription model box. I was like, I would love to just get a handful of tattoos each month in the mail. So Inkbox, if you're listening, that's Meb's suggestion. I'll be your first subscriber.
Exactly.
Say, here's my preferences. I like floral. I like, animals. I like, just give me the potpourri, whatever.
Totally.
Just send me some. Anyway, listeners, check it out. My son loves it. I
love it.
Shift away from consumer then. Pick one that you like, that you think is a fun case study, either one that you've thought of recently, invested, or one that have been it's in the works for a while.
Yeah, I mean, we fortunately have a bunch of companies that are doing tracking really well, right? From this is a very new fund, so a company that we I mentioned before was that Moicor, which is software AI machine learning to interpret blood counts for veterinary diagnostics. And so when we met them, they were they're team of three. Two were graduating from undergrad at Penn State. And so like no one cares about Penn State here in the Valley. That I went to Berkeley. People don't care about Berkeley. They care about Stanford. They care about the big name schools. And just is what it is. And so people definitely do not care about a small school on the East Coast that's not Harvard. And so we got to know them. We met them through an angel investor. Really appreciated. We got to know them over 5 months. And so, sectors are very important, but ultimately at the seed and pre-seed stage, you're betting on people and the way they make decisions, and the point of view that they develop. And that point of view can come from an experience at a big company, an experience in a prior life, or a built up accumulation of study, right? And so they had a point of view that they built up, starting with analyzing the CBCs in the lab at Penn State, which is a very strong lab and research component to that school. And so they were pre-med students. They built up, they had this thesis, and then they started applying it to pets, and not only cats and dogs. They started applying it to an area of people's pets, which were birds and reptiles that were very overlooked. And so people bring in these animals. It could be a dog to a reptile, and they want to know what's wrong with their pet, right? Because just like even with the human, if something is wrong and it's terminal, every minute counts. And so faster results can only help the outcomes. And so unless you were a big veterinary shop, you'd have to buy these, and then you could afford these big machines to put in these blood samples to get results. There are literally vets that are in that are mobile vets. There are vets that are one vet per office. And so by definition, the P&L that they run, they can't afford these big pieces of machinery. So oftentimes when they take these blood samples, they have to send them in somewhere. And so they wanted to kind of flip it on the head and give them faster reading. And so I got to know them over a few months. We led their pre-seed round. They built out the software, and now they raised their Series A early. They graduated from YC. They raised their Series A earlier this year. And it's just been awesome. I actually had dinner with them last night. So I went and saw their new office, and they moved out from Pennsylvania to Oakland. Now they just recently moved into their office in San Francisco. And it's just amazing to see their growth as people. And they're still only 23 or 24. So I don't know what you were doing at 24. I definitely was not I was not a CEO of a company. So seeing their growth and what they've accomplished, super awesome. It makes me very proud. And just to see their traction and their sales, and they're growing like a weed. And so, those are the things that brings me joy. And so I don't know what the future holds. I think it's going to be great. But I think we've already done, I always say this, celebrate the mini milestones, because and I remember even one final thing with them is when we were raising that last round of financing, I told Chevy, the CEO, I said, hey man, take a breath and just can you believe you're raising this so much money? And
Yeah.
and he said, yeah, it's crazy. And I was like, I mean, I can't believe it. He's like, I can't believe you funded us, I can't, and so and just that interaction and that celebration is just, it's pretty powerful. It's worth more than any dollar that I can make on that company, or any dollar that I've made. And that brought me tremendous joy. So that's a company that's doing really well. Happy to share more.
I was laughing as you're saying, I don't know what you're doing when you were 23, because I distinctly remember visiting Penn State when I was 23, because my buddy opened a sandwich shop up there right out of college, and remember thinking, man, it's cold up here. Holy cow.
That's why you spend a lot of time in the lab and you test, CBCs, and then
100%. I was like, if you're going to do engineering or med and devices, what a perfect location for it. Somewhere where it's cold.
Exactly.
But that's a fun spot. All right. What are some other themes? I know of no more antiquated industry that has a significant amount of fat and frustration, sort of what I call frustration arbitrage, where the way that it's done is so antiquated, than the real estate space. And the one I'm thinking of is Homelister. Is that one that is they're publicly out of beta, right? Is that company?
Yeah, no, they're in over 15 markets. Business is booming. The real estate market is on fire. And so what they do is, they take out the sell side realtor, and they're kind of like an online realtor. It's not Compass. It's completely online. You can go sign up, and people that live in big cities, it's probably not relevant because there is volatility in pricing, and you might need a realtor for higher priced homes. But in small towns or in Las Vegas, where in a community, usually there is not much delta or separation in the price per square foot when something gets sold, like within the same neighborhood, even within like a short period of time. And so, what is the theoretical value of that sell side realtor? It's like you need to put your house up. It needs to be syndicated across like appropriate platforms, like most importantly, traditionally the MLS, maybe across some, other online mediums like, Zillow, et cetera. But other than that, there isn't tremendous value around pricing, especially. So, they kind of want to do that at a lower cost rate. And so, we think that that's something that we think the timing is perfect, because there used to be heavy regulation when it came to even state by state and city by city, and working with kind of the legacy agencies. And so, we think, those things have those issues are starting to pass. And so we think the timing is right for Homelister. And funny enough, I met the CEO, Lindsay McLean. I met her over 5 years ago. And so I talked to her last week, and I'm like, she's just a cockroach, and so, and I don't say that in a bad way. I mean, she just hasn't died, never recapped the company. But what's a big piece of success for startups? It's timing. Yeah. And so she's just been so gritty and so determined that she didn't let anything kill the business. But time has changed the industry to make her, I think, poised for a ton of success. And so, still a ton of work to do. But we think, the business is well positioned. And we've had success, kind of, in the higher end with a company called Side that I did the pre-seed in 2016. And they just recently announced, a $2.5 billion valuation.
Wow.
Funding round a couple of months ago. They help. They're kind of the opposite of this. They work with the realtor on the high end, where they need more software to build their business, where the high-end realtor, actually their brand is what's most important, the person's brand or their team's brand, less about the brand of the agency, a Remax or a Keller Williams or a Century 21. It's actually the people are more important. And so they empower these realtors that are at the top end of the market to build their own brand, standalone. And they are a virtual online brokerage, and they empower these high-end realtors, and they give them a ton of technology to make them run their business. It's like high-end real estate in a box, and help them scale their brand, hire other people, have more output. So they've been tremendously successful as well. So that pattern recognition really helped for Homelisters, in addition to knowing the CEO for a while.
You mentioned an interesting topic, an observation, which is, this concept of timing. And we say this about the investing world, where over the course of 10 years, half of the mutual funds close, which is an astonishing number of just attrition from and ends up being survivor bias. But and obviously the same thing applies to entrepreneurship and startups too, where we say that the biggest compliment you can give anyone in our world is just surviving. All right. The fact you keep the doors open and can make it is already like a huge compliment in itself, because it's so hard. And capitalism, free markets, that's the thing. Like creative destruction is everyone's in the arena together, and it's tough just to even keep not drowning. So to succeed is even more rare, but a lot of it, there's an element of luck and timing too, in addition to hard work. I don't want to keep you too long, but let's keep chatting about a few of these themes. Anything else we haven't covered as far as the companies and ideas that you're particularly interested in here in the end of summer 2021?
I mean, I'm a people-driven investor, so we love enterprise and we love that top-down approach. And there are certain areas that we look for, but oftentimes I learn a lot from these people, talking about the Moicor example. It's like you learn from their insights, and then you understand them and how they think about it, and you can make a decision right or wrong if you think that approach is right. But ultimately we're betting on teams and people, and those people's ability to hire other great people. And so I think, I think oftentimes we focus on industry size or potential, but really if to your point about timing and grit, if they don't have it in them, they don't have it in them, right? And so I think that's why we get to know people and we spend time with them, and then we do references and we do all of that stuff before writing a check, because we're investing in people. And so all of that is the data that we create around those, in addition to the time we spend with them, right? And so we need to CYA also, right, by doing that work. And so I think so we're very bottoms up from that perspective as well.
You mentioned kind of, I imagine at this point, the largest percentage of your, and correct me, I could be totally wrong, of your introductions, interactions has been through probably your network of meeting people for the past decade. How often is it that you're seeing startups from a random cold email, or what's your process for unearthing all of these, like the 22-year-old founders? Like, how do you come across a lot of these? Is it through friends of friends, or is it through all sorts of angles?
Yeah, I mean, I'm pretty easy to reach. Like literally you can go on our website and, to your point, send a cold email. If you have like half of a brain cell, you can probably figure out what our email address is just from knowing the URL of the Parade website. But you'd be surprised.
Sorry, not to interrupt you, but this is one of my favorite, like a day does not pass where people will ping me on Twitter or elsewhere and say something, I'll respond and they say, okay, great, I'd love to email you. What's your email? And probably like you, like have the easiest email on the planet to find, and then never hear from them again. It's where it's.
I mean, yeah, yes.
Not only is if it's easy to find, you can also, listeners, like there's Rocket Reach, any of these services that'll just like tell you someone's email. So it's like if you don't do this very tiny bare minimum of effort, like it's like I can't help you anymore. So.
Well, like I said, entrepreneurship is decision making, it's resourcefulness, it's all of those things. If you can't find my email out, then we have other problems. So like, and I also think, hopefully we met a bunch of people over time. You can probably get an introduction even from someone that I don't know super well, but an introduction is better than no introduction. But no, I mean, I respond to cold emails. I respond to every email I get. I do it as a source of pride, and so, but I think if you do go that route, make it a pretty compelling email, right?
Yeah.
To your point, I write probably on my website that I like fantasy sports, and people have like addressed that, but I wouldn't say like that's enough to like make me take a meeting and use my time. Like we want to spend time with founders that come from higher signal, right? Like angel investors that we worked with. Like I'm going to take a meeting from a founder if a founder introduces me to somebody that's their friend or someone that they've worked with. Like I'm obligated almost sometimes to take some of these meetings. And so like, you're just going to have lower conversion if you come in cold. I think of everything in terms of conversion. And so your first milestone of conversion is getting getting a response, which I said I will do. But then the next thing is getting the meeting. And so I think telling your story in the right way. Like I know other investors that have invested off of cold emails. It's definitely not a majority of their investments. It's probably like 1 or 2 in the history of all their investments. And so I think bias is a killer in our business, especially at this stage that we invest in. You have to figure out ways to take risk. And so I always try to have an open mind, but I think as a founder, to best position yourself for conversion and success, it behooves you not to find like the right intro to the person. It'll just set you up on the higher side of the decision tree, to hopefully put you on a track to getting a yes, rather than climbing yourself out of the lower section of the decision tree to get to that yes.
Yeah.
You don't want to come out of the loser's bracket. It's way harder.
It's way harder. As you look kind of like, you're still young in this game, but you've been a part of a lot of deals by number at the seed stage. And you look back and reflect on the ones over the past decade almost. Obviously, they all pass your filter in the beginning to the check stage. So you're excited about them. How much sort of retroactive analytics could you apply to the ones that actually had the breakout success and attribute it to any particular variable. Could say, look, having done 100 deals, I can look back and see that, these things were clearly of utmost importance, or, hey, there's a fair amount of randomness. I don't know. It's hard to make any conclusions about the eventual outcome. Any general thoughts?
I don't know. I just try to focus on simple things. Like I help them get off the ground. I help them like build teams. I help them like find product market fit. And like, I just try to focus one foot in front of the other. And if it works out, it works out. If it doesn't, it doesn't. I try to trust the math, like you mentioned before, and try to get less emotional about it. It's really hard when you invest, day zero, oftentimes. So we just try to, I try not to overthink things. Everyone says, oh, as an investor, it's like the people or who you bet on, and they're gonna the outcome's gonna be the outcome. I don't take credit for any of it, but it's a team effort, and our job as investors is not to run their business. Like I don't want to run anyone's business, but it's to give them anecdotes of things that we've seen to help them make better decisions, right? And so I'm hoping over time that I have like given tidbits, and even if it's like on the margins add up, and so over time, hopefully we do make some level of a difference. And that CEO says, I was happy to take Parade Ventures money. Like, that's all I want, right? I don't want credit. I just want them to feel happy with the partnership. And so like, I think we do add value. And so I just focus on those little things, whatever it is. Every team is different. Every team's more, some people just need someone to talk to, right? Some people need help with fundraising. Some people don't need help with fundraising. Like they're all different. I don't know anything about, the vet space. I do know what future investors are looking for, so I can help them, think through that, what KPIs they should probably track to tell a compelling story. I know what a good story looks like. So there are areas that I can, horizontally share information from a cross section of our companies throughout, now over 7 years of investing, to your point, touching hundreds of companies. We can probably share a thing or two that could be helpful to a business. So I focus on these small things. And then everything, there's a lot of, like, I don't know when the market's going to crash, when the bull market's going to continue. Like, I'm not smart enough to figure that out. Maybe you are, but I'm not.
What's the state of venture today? You kind of just led into this one. There's been a big evolution over the past 10 years. As you mentioned, syndicates didn't really exist in the form that they did, they do now, really, a decade ago. There's been this huge proliferation of people that are kind of earlier stage, whether it's individuals. Obviously, you've had valuations go up across the board for everything. What are some general takeaways that you have, if any, about the environment over the last 10 years, as well as the last year, how things have evolved, good, bad, in between?
I mean, I think this is the funnest time I've ever had as an investor, or probably it's better time to be, not a better time to be an entrepreneur. Like, great companies are being, I think, it's still early when you just invest, but they're getting created every day. There's a ton of capital out there, smart capital. Valuations might be high, but I was talking to somebody yesterday. He, at his prior firm, wrote a check into Canva, which is, worth whatever multiples in billions. And I was like, he's like telling me it was the first round of funding. He told me the price, and I was like, my reaction, I won't get into the numbers, but it's like, I was like, that's expensive. Mm-hmm. So like, it's all relative. Things have been expensive also, up and down, for the past like 10 years. We find value in the market, sub $10 million valuations. People are like, how do you find that? And we do. It might not always be here in the Bay Area, but I think there's opportunity out there, and I think it's a great time to be a seed investor, a Series A investor. It's awesome to see the Tigers of the world and Andreessen's even, right, raising later stage vehicles to support founders. And so I think people also have to remember, like, and I come from, like, building a marketplace for mutual funds to connect with late stage companies. Like, mutual fund capital is in the trillions of dollars. Yeah. Like, people can talk about the increase of venture financing. It's still a rounding error.
Rounding error of a rounding error. Speck of sand.
So, I know you're on the Twitter, and I love Twitter, but the noise to reality ratio is pretty high. And the tech Twitter is pretty loud. And so, it's probably a little louder than it needs to be, or what it is relative to the impact that it has from a dollar's perspective. And so I just think I always try to keep that in mind.
Yeah, I mean, it's astonishing to me, the consistent innovation that I see on a daily basis from so many of these startups. It's kind of floors me. And the nice analogy I like to give is, because we've been trying to, educate and encourage our investors over the years to at least get interested in this world, whether they do any angel investing, just to dip your toe in the water and pay attention, because one of the biggest benefits is it's so optimistic, right? You're looking to the future. These young people, old people, could be both, building amazing companies, trying to change the world, all this stuff. But it definitely gives a foil to like watching financial news networks where people are screaming and shouting and pessimistic all day, right? Like the world's ending. And so it's a nice balance between the two to try to at least feel out both sides. But it's also
my area of the world, we go from 0 to hopefully around $1 million in ARR, and then we bring on other smarter people that are able to take them from $1 million to 5 to 10 to 15, whatever those jumps
so
are.
You guys don't do any traditional follow-on?
We do, but then you're following on by definition of what you just said, right? And so there's a new lead. So when we take our lead position, we know our job, and that's the most important part of our job. Of course, we always continue to support the company both financially and as partners. But the main part of our job as a seed investor is to get them to some level of product market fit and raise more capital and raise a Series A, hopefully next.
Are there any type of opportunities as far as either companies, industries that you haven't allocated to, or that you would love to allocate to, but you just haven't seen the right company in the space that you're excited about? Is there any themes that you're like, oh man, I would just love to do X, but nothing's there yet?
I mean, I'd love to do more in like crypto. Like, I mean, we are allowed to, and maybe not like crypto, but like crypto applications and like understanding that. And so we have over the years, like we even had a crypto, or it was called a Bitcoin syndicate in 2014, like me and Gil under Flight VC. So like not new to it. I always like try to figure out like, where is our edge? Like why are we winning deals? Like why, or what are we seeing or understanding that puts us in position to want to invest that people aren't seeing? And that's worked for me before, and taking that risk. So I think there are areas like that we want to figure out. We did our first investment in Latin America earlier this year, so going international. So we'd love to do that in India, and talking to a team in the UK right now that'll probably close soon. And so, just broadening our aperture in variety of ways. It could be sectors, it could be geos. And so I think from a geo and a deal evaluation perspective, COVID's been very helpful with that, because you could be in Timbuktu right now. Like I wouldn't know, right? I know we're in the same state, but it matters less than it did before.
You mentioned the value add is the main benefit. You think the relationship with the founders, like when you talk to one, if they're to say, all right, look, I'm deciding between you, XYZ, I don't know how often that actually happens. If you're actually sourcing and digging these up, if that is rare, or if it's common in 2021, but to the extent it is, like, what do you tell them? Like, how do you kind of say, this is who you should pick for the prom?
I mean, even though I've been doing this for a while, I don't have 1 million Twitter followers, but I focus on my relationship with the person across the table or across the computer for me. And I focus on that and that alone. And I think if I do a good job of building that relationship, hopefully they'll want to figure out a way to have me around the table, maybe as a lead or not. And if they don't want me around the table, I haven't done my job. So I don't know. I think when it becomes a competitive situation and you're competing with firms of all kind of different value add theses, brand, etc., size. You could be competing with Sequoia on a deal. It's a small pre-seed and seed fund, that's just going to be harder to win by definition. And it's not an easy decision. I don't envy the founder in that. I do envy the founder, but I don't at the same time, right? Like I always used to, I remember like when before starting my first venture fund, going interviewing with, you know, a company, great company. And I was like, I realized I didn't want to go work for that company. But I said, if I continue this process, I'm going to probably take the job. And so, you know, like it's hard as a founder to pick the partner that's right for you. If you get a term sheet from the best venture capital firm in the world, Sequoia Capital, how are you going to turn that down? It's not right for every person, every piece of capital down to the partner level, right? Like finding that firm partner fit for your stage, like it's not trivial. And especially for like a first-time founder, getting everyone telling them what to do, like that's a hard decision to make. And so I try to focus less on that stuff and just focus on our relationship and what we can do to help. And then we leverage our founders that we back to support us and say, and to pound the table for us. Like that's the best testament to help to try to win. But you know, that's that. I don't know if that approach is right or wrong, but that's the approach that we take.
Prior founder testimonial is probably the gold star. If you were to chat with someone who's on the other side of the table, so all these angel investors, particularly the newer ones, any advice you give them as they consider putting money to work? And I'm not talking to like the big allocators that, you know, have been doing it for a while, but just in general, the people who are interested in investing in sort of startups at the seed stage. Any general thoughts for them?
I mean, it goes back to the math game, right? It's like place enough bets to create like a regular portfolio. I think I've always said like what's beautiful about AngelList is you can still go, it's not really tailored as much to like the long tail consumer now, but you can go sign up for a bunch of SPVs and put $1,000 in a bunch of deals. Like start getting your brain working towards it. And who cares if you have to pay carry, and who cares if you're not sourcing the deal? Like learn to pick. Picking is more important. You can put money to work real easy. You can see deals, and you have to invest in good companies. And so like just start getting that, you know, brain working towards that. And you can literally do it via AngelList to start working and getting that venture experience and get your wheels turning. Like I've been doing that with companies since 2005. So it's like, you know, if you think about it as 10,000 hours or however you want to quantify it, it's like before AngelList, like I didn't even have that ability to do so. I remember like reading TechCrunch when I first started and be like, oh, that company is cool, I'd probably invest in it. You know, that was my version of AngelList. And so, I mean, I think there's so many avenues to be able to do it. And you don't have to go write a $5,000 or $10,000 check. You can do it on a shoestring budget with the, you know, writing $1,000 check. Like that's pretty rad.
Yeah. No, as we were telling investors, I said, you know, I look back at just even the AngelList specific, and they have a stat on the like past deals page. It's like you've reviewed 3,500 companies. And the fun part about that, in addition to like, there's so much you learn and can apply to your own life. Like so many of these companies I never even invested in, but I'm like, oh, that's cool, I could use that, or I'll pass it to my legal buddy. I'm like, hey, have you seen this? And he's like, no. Or like, most of my friends are sick of it now at this point, because they know anytime they hear, hey, have you heard of it? They're like, oh God, it's another startup. But hugely useful, even if you don't invest. But I agree. I like totally. you start to learn so much just from being osmosis of getting to read about it.
It's intellectual curiosity, right? It's like, how much do you want to learn? And like, everyone thinks they can be an angel investor, but like anything to be the best, it's hard. Like, I don't know, like, and if it's easy, like, you know, and people make it look easy, right? LeBron James makes it look easy, but that guy works his rear off, right? And so like, I think anyone in any profession does if they want to be the best. And so you can get lucky for sure. But sustained excellence, it takes a lot of work.
As we look to the horizon, what's the plan for Shawn and Parade and company? You seem to be in a pretty great spot right now, but what are the next 3, 5, 10 years look like?
I'm gonna do the same thing. Invest in enterprise startups, be high conviction, high partnership driven, work closely with them, be aligned with their success. Like, I'm not gonna, fund one, fund two, same strategy, nothing's changed. So like, we want to be known for want to be known for something in the ecosystem. Hey, we're a B2B company. You know, we should go talk to Parade Ventures, or just even consumer. We just want to help founders. We want to be super helpful, super responsive, founder friendly. I know it's overused, but like I literally respond to every email I get. So, you know, and sometimes it takes a few days, but we respond. And so, you know, you know, those are the kind of moral fibers and pillars that we're built on. And so, you know, we want to just do it with consistency. Consistency wins, I heard.
And that's parade.vc. You guys, if you can't find his email, that's on you. Shawn, what's been your most memorable investment? It could be good, it could be bad. It doesn't have to be a startup, but just the one that's seared into your brain, that jumps out at you. Anything come to mind?
Well, I mean, you know, another one that's raised a bunch of money that we were in the first round is Bob and Shaw's company, MoveWorks. They just announced a $2.1 billion valuation. And like, I've known him since his company before that called Refresh. You know, he went from being a consumer founder to a hardcore enterprise founder. You know, going through the ideation stage, working with them, being a part of that first round, and seeing them take it to reality. You know, it's you know, going back to the long feedback cycle. So, you know, we have Side and we have MoveWorks to give us validation on, you know, Shawn Merani's personal track record. That's helpful. But it's taken many years, but seeing people fulfill their vision and people that were friends and or have become friends given the partnership dynamic. Like, again, like going back to Moicor, like just seeing these people fulfilling their visions through hard work and some luck, but bringing other great people around them. Like, I mean, it's amazing. It's just, it's like, and there's multiple examples of that. And even companies that have gone from seed to series A or B, like it's still early, but you gotta appreciate every milestone. Each is hard in its own way. And I just love being, you know, just seeing that and empowering people to do that. Like being and really fulfilling their potential. So it's not, there's specific examples and it's just non-specific, but so lucky to do this job.
Yeah, I mean, it's that special moment where you see something, particularly that when it works, it's like almost it gives you chills, right? Like you see this happening and this perfect moment in time, also because it's so rare, but it's a great feeling. Shawn, this has been a blast. Thanks so much for joining us today.
Thanks for having me. Hopefully a couple of people enjoy.